Thank you for having me. Great being on the show.
Yep. We're joined by Prableen Bajpai, founder of FinFix Research and Analytics on the show. Prableen, always good having you. Thanks for taking the time out. Good afternoon to you. I wanted to think about this, Prableen. So many people must be thinking of starting off SIPs at the current juncture in the new year, so to say, though we are already in May, but be that as it may. So for people who are not shying away from taking that call 20 days before the election, if I had to push you to recommend two categories of SIPs where you believe people can start off investing, what would those be?
Good afternoon, Neeraj. Great to be on the show. I was just listening to your conversation with Vishal, and I guess multi-asset is a great category to start with for moderate risk investors. But if I have to pick two categories for investors who belong to the high risk appetite and do have, let's say, a 10-ish and plus horizon, then the first category would be a multi-cap fund. Multi-cap funds, as we know, Neeraj, can invest into large, mid, and small cap funds with a minimum 25% allocation, and the remaining 25% is as per the fund manager's discretion. And why this category? Because I think it brings in the stability of the large caps along with the growth potential that mid caps and small caps offer. And within this category, the fund that I like, one of the funds which I like is the Nippon.
Okay, I think we've just lost that line. We'll just get that going. I think she was about to start talking about the Nippon fund, but I think we just lost that line. We'll try and patch that quickly and then try and ask Prableen more about what it is that she was trying to say. Hang on for a bit. Okay, I think we do have Prableen back. Sorry, Prableen, I think we lost you. Can blame it on the internet. Yeah. But yeah, could you just, no problem at all. Can you please finish your answer?
Yeah, so the Nippon multi-cap fund, Neeraj, this is a very old fund. It's got a 20-year plus, 20-year, almost a 20-year track record, and managed with a a value and a growth strategy, a mix of the two. It follows both top-down and bottom-up approach at the same time. The fund has been able to participate in the market rallies as well as has been able to contain the downside. I think it's a good addition for portfolios where the horizon is long-term, because a lot of people don't go and individually pick a small cap right in the beginning or a mid cap. And I think this can be a decent start for any investor who has a long-term horizon, not for anybody who has, let's say, a less than 5 to 6 year horizon. And the scheme has performed well, with decent rolling returns as well as XIR returns in the last 5 years have been in, between 29 to 30% returns. So that's one fun. The second one, Neeraj, is a passive strategy. I think passive strategies are again, which are very useful for investors, especially who have a real long-term horizon, again exceeding 10 years and beyond. And within that, my choice is a mid-cap 150 index fund. So of course, within the passives, the fund house, we would want to choose a fund house where the tracking difference is the least. So we have different fund houses offering this strategy. And if you look at the past 10 years, Neeraj, the rationale for investing in a passive mid-cap fund is because only about 4 to 5 actively managed funds have been able to beat the index, with a substantial margin. So when I say substantial, 2% and more. So with a handful of active funds being able to beat the mid-cap index, I think adding a mid-cap index again is a good idea. You asked me to suggest two funds. If I had my way, then I would have added a passive large cap strategy as well. So a large cap passive or mid cap passive to complement it, a multi cap fund.
Got it. Okay, Prableen, thanks for that. Prableen, there are a lot of people who write queries to us. We try and answer some of those. For paucity of time, we'll probably be able to take 2 queries, but would love for you to try and help both of these gentlemen, I believe, into this. The first one is from Deep Sanbi. Deep is 31 years old. The goal is a lump sum return. Deep wants to create a corpus for his daughter's education. The daughter is 3 months old, and a retirement corpus of 2 crores. Both of these over the next 15 years. His question is, he's got some investments. His question is, has he chosen the right funds for achieving his goals? Now, bear with me, probably, and I'll try and tell you some of the investments that he has. He's got an investment, an SIP investment in Parag Parikh Flexi Cap Fund, 1850 rupees. Kotak Multi Cap Fund about 1850. SBI Contra Fund about 8050. ICICI Peru India Opportunities the same amount, as well as Quant Large Cap and Mid Cap Fund about 1850. Then he's got some others like Edelweiss Mid Cap, Edelweiss Mid Cap Momentum, Mire Small Cap 250, Nippon India Small Cap as well. So in all about 9 or 10 funds. Now this is difficult maybe to answer at such a short go, Prablin, but based on whatever I've told you, is there any advice that you can give to Deep?
Right. So, Neeraj, it's great that because his child is really young. So, education goal is really important with education inflation in India at about 10 to 12%. And, I think more than the funds, it's important if he's set a target for himself. So, let's say that today for his daughter's education, he would require about 30 lakhs. This 30 lakhs in the next 17 years at 10% inflation will become about 1.5 crores. So first, he really needs to set a target for himself. And for this, individually, he would require an SIP of about 23,000 per month. If I'm assuming an XIRR of 12%, which is slightly on the conservative side, but I think it's better because we really don't know, the uncertainties regarding taxation and other things. So I think 12% is okay. And second, Neeraj, that for his own retirement, he set a corpus of about 2 crores. This corpus will only be worth about 83 lakhs in the next, this time period that he's given to us, 15 years. And if he actually wants inflation adjusted 2 crores, that means that he actually requires about 4.8 crores for himself. So that also needs to be recalculated. The schemes are okay. Already 9 funds, Neeraj, an active passive in the mid and the small cap space. Rest, he's got a lot of active funds from the value and multi-cap and flexi-cap. I think, okay, he can just continue with all of these, but there is just no need to add any other scheme in his portfolio. And maybe over a period of time, 1 or 2 schemes can actually be removed.
Okay. Well, Sanvi, I hope you got the advice and the rationale for that as well. And I'm certain this was helpful. The next query is from Brijesh Patel. Brijesh is age 33 years, excuse me. Brijesh's query is, goal is lump sum returns. He says, I want to invest 5 crore rupees for the next 5 years and get 24 to 26% returns. What's the best course of action? Should he invest or should I invest in mutual funds or stocks or both? Probably tall target, 26%.
Yeah, and because he's asking that whether it should be mutual fund or stocks, I believe that he's not doing actively, like he's probably not managing too many stocks at present. So, Neeraj, it's great because we've seen in the last 5 years, if we look at the returns, we have been able to achieve this kind of returns, but that's mostly in the small cap space or, some of the funds in the multi-cap and sectoral funds. So firstly, that if we are able to create a portfolio like this, it would be a very, very high risk portfolio. Second, that he really needs to be sure if his goal can be extended. Let's say if markets don't favor and what if we see something like, a 2008 fall, and then for the next 4 to 5 years, it took time if you had invested at market highs to make very, very, nominal returns. So I think first he really needs to be sure if he can extend his goal, and that can go up to, let's say, 7 to 8, 9 years. And not limit to 5 years, then it's okay. If it's a crucial goal, let's say some marriage or education or something very important, then I feel that he definitely needs to be sure about the kind of risk that he needs to undertake. And I think a moderate risk portfolio would be better with, funds categories like the multi-asset and probably more large cap tilted with a multi-cap fund to add, the mid-cap and the small cap to it. So the construct would totally change depending on, if there is rigidity in terms of the goal or not. But if it has to be a very high risk portfolio and he's okay to take that risk, then it will be a very, small cap centric kind of a portfolio with sectoral funds.
Okay. Probably in just one quick personal finance question on a mutual fund show, but somebody brought this out. I'm just throwing this out of the dark at you. But somebody made this interesting point that everybody talks about keeping a contingency fund in a fixed deposit. If you have a credit card which has got a limit of 10 lakh rupees or above, does that serve as your contingency fund and you need not block your money in an FD, instead invest it, because at any point of time, even if you're spending the money on the last day of your billings or the first day of your new cycle or the last day of your cycle, you still get about 15 days to liquidate any other investment and pay the bill. So why bother with a contingency fund?
So I think Neeraj, a simple answer here that of course this is a choice, and a lot of new age investors like to utilize their credit cards for various purposes. You can do that, but let's say that you have 10 days to then pay off that 10 lakhs that you have spent. You will probably liquidate one of your long term holdings because obviously you don't have anything parked for the near term or for the short term, and that means that you're also jeopardizing the whole process of long term, maybe your retirement goal, maybe something that's for your child's education, something kept for your home, for buying a house. So why disturb that process of compounding? I think contingency fund, you shouldn't look at the returns. That's something which is very essential. You can keep it in an FD, an arbitrage fund, depending on what your tax slab is. But because this has to be even repaid within, even if you're using a credit card, I think that would kind of disturb your overall portfolio because something will be sold to cater to this. And if it's not in debt or a fixed income product, then definitely you are disturbing the whole planning process, probably for your long term goals.
Okay, but if suitably chosen, who knows, might be an option. But it's a personal finance question, not a part of the mutual fund show. But somebody posed it to me. I found it interesting. Thought we'll kind of throw it out of the dark at Prableen. Prableen, thanks so much for taking the time out and being with us on the show today. Lovely talking to you as always.
Always a pleasure, Neeraj. Thank you.
That pleasure was ours, and viewers, thanks for tuning in.